everyone. This is Jeff Cockrell from McGuire Woods. We're joining, reconnecting our series, which we've titled the Independent Sponsor Healthcare Coalition. And I apologize, there's jets flying around in Chicago, so it's definitely the air show this weekend and not us being attacked by hostile forces, so you may hear that from time to time. But as most folks know, we're one of the leaders in the independent sponsor arena, and through this independent sponsor healthcare coalition, we're trying to bring together the participants in the independent sponsor community that spend a significant amount of their time in healthcare deals for a couple reasons. One is there are specific issues that run through healthcare deals that are unique to those deals. And there's also some differences in the capital providers that are relating to those deals. And a big part of what we do is connecting deals with capital providers, and it's a little different universe of capital providers that live in that space. We're going to be talking today about some issues that you need to be mindful of at the LOI stage, and we as the lawyers are sometimes involved at the LOI stage, sometimes not. So these are good ones for, in particular, an independent sponsor to be keyed into, because there are some peculiar elements of a healthcare, in particular, healthcare provider services deal. But before we jump into that, I'm joined by my colleague, Alyssa Campbell. And Alyssa, you want to give a quick introduction as well?
Sure. Thanks, everyone, for joining us today. I work with Jeff in the mergers and acquisitions space, primarily in healthcare. I do about half of my deals in the physician practice management space and about the other half or so in what I call kind of healthcare light industries, things that are a little less regulated and often don't employ physicians, like the speech pathology, behavioral health, durable medical supply type space. And so thanks again, everyone, for joining. And we're really excited to walk through some things for you all to keep in mind as you're preparing LOIs or speaking with potential sellers, and hopefully some tips and tricks that'll save you time and money in the future.
And one little plug for our conference coming up, hoping to see most of you at our Dallas Independent Sponsor Conference. It's October 25th and 26th. There will be some special programming for those that are in the healthcare investing arena, but it's always a industry-leading event where a lot of capital providers and independent sponsors make a lot of connections. So hoping to see you at our conference in Dallas. Liza, we're probably ready to put the slides up. Getting started, it's probably worth noting that one of the peculiar elements of a healthcare deal right at the outset touches on the structure of the deal. In most states, or many states, there are prohibitions against non-physicians owning a professional corporation or professional limited liability company, which interjects right at the outset some questions around how you're going to be navigating the structure. And Liza, we can probably flip to the next slide. The structure of the deal touches on kind of three specific components. One is there's an impact on the structure for tax purposes. There'll be there's almost always different tax outcomes between doing an asset deal and an equity deal. Sometimes those differences are muted. Sometimes they're rather profound. There's also differences, and before we leave the tax, it's almost always better for the seller to do an equity deal. And there are instances where the tax impact of doing something other than an equity deal are so profound that you're going to have to find a way to do an equity deal. But the seller would usually prefer an equity deal. The buyer is usually preferring some version of an asset deal. They'll get a basis step up and better tax treatment in their hands. So there's a tax difference. There's also a liability difference in that if you're the seller of a corporation or an entity, all the liabilities of that entity kind of go with the entity. In an asset deal, a buyer can be selective about the liabilities that they agree to assume, and ones that they don't assume kind of stay with the seller. But all that gets some complications arise when you interject the corporate practice of medicine limitations, that if the buyer can't buy the equity at all, you're going to have to find another solution. And where that really touches on the LOI is it presents a bit of a conundrum as at a number of levels as to how to approach it. The first is, as a buyer, you may not know exactly what kind of structure you're dealing with. And you could stop at that moment and really dig into the structure of the seller and try to solve all these pieces on the front end, but you may not know them right at the outset. There's also issues around whether or not you want to pin down all of these answers at the outset. The seller may have specific desires. You may have different desires as a buyer, and you could either tackle those right at the outset or punt a little bit. But when you punt a little bit, the challenge there is you run the risk that there's a disconnect in the expected tax treatment that is connected to the price that you just offered. So if you offer $20 million for a small platform, the seller agrees to that, but you have a disconnect on what the tax treatment's going to be. You may not have an exact meeting of the minds on that, which is going to send you down the path of having to negotiate those elements in the future. But you may or may not have, as the buyer, all of the leverage at that future point. So it really is a conundrum as to whether or not you want to enter into negotiation of all of those points right at the outset. And then the last thing to consider is, even if you want to not exactly talk about it, how you're going to answer those questions, you got to find some way to at least talk about what you're doing in the letter of intent. You can talk about buying the assets. You can talk about buying the equity. You could also talk about buying the quote unquote business and be a little bit amorphous as to what that is going to look like. And then when you connect that with the corporate practice limitations, there's an additional complexity, is that you structurally may need to do something that is not very typical. The MSOPC structures usually have a practice staying in place, and you're moving non-clinical assets and goodwill and doing all these kind of hinky things that you would not normally do. And the question is, do you really want to drag a seller who may not be very initiated with that? They may, especially on a smaller target, the council may not be very initiated on what corporate practice structures look like. Then you have to stop and consider whether or not you really want to drag everybody through all of the permutations of what this is going to look like to comply with corporate practice limitations, to connect those limitations with tax and liability things. It's just a bit of a hornet's nest. So,
and drilling that down into how a pathway that we found success in that lands you in the middle between being so specific that it requires a significant amount of pre-LOI type diligence on the legal and business front to be able to nail in the structure. And then on the other end, being too vague such that you have to renegotiate certain portions of the deal. As Jeff was saying, we like to include language that you are going to buy the business for the purchase price. And then kind of the second prong is that you include that the deal will be structured as necessary to comply with state and corporate applicable, state and federal applicable corporate practice of medicine laws. And then to get you to the beneficial tax treatment where you can vary the structure once you've done your more business and regulatory due diligence, we like to put that in any event, the deal will be structured to provide the buyer with a step up in the basis of the assets, and that you may require a corporate conversion to own the entity as a flow through post-closing. And so basically through those three different prongs, buying the business plus structuring in compliance with law, plus getting the basis and raising that there may be a requirement for a corporate conversion, you will land with both flexibility to structure the deal as necessary later. You save yourself some upfront costs in securing that flexibility, but you also give the seller all of the information that they would need to do their own tax analysis. And so if they neglect to do that, you sort of have the upper hand later if they kind of bring it back up and say, well, I didn't know I was going to have to, double pay taxes because I'm selling you my assets out of a C Corp. You're like, well, I told you from the start that I wanted the step up, and then they're in a position where they need to convince you rather than vice versa. And so we found that to be, doing all of your diligence up front and being the most specific is best, but this is what we found to be sort of second best and often the most pragmatic.
It avoids having every fight right at the front end, but it at least lets you plant a flag on the kind of ultimate structural elements that are important to you as a buyer. Moving on, and we're going to kind of just tick through a bunch of little topics that you need to be mindful of on the front end. Another topic that comes up a lot is physician alignment and what the compensation apparatus is going to look like. In provider services deals in particular, the EBITDA is often created by scraping some of the aggregate take-home dollars that the owner doctors were making before. And they may have been receiving those aggregate dollars in some combination of compensation payments or compensation payments plus distributions. But to create the EBITDA, you have to scrape some of that out. And that puts pressure on what the structure is going to look like going forward. And increasingly, in particular, sophisticated buyers are leaning into some of the more elaborate structural elements to help bridge the pain that the selling doctors feel from that scrape of income. And the historic model would be to say, okay, you were making $1 million before, we're going to scrape, let's say all the doctors are making $1 million, we're going to scrape 20% of that, and you're going to make $800,000 going forward, and your compensation is going to be exclusively a function of production, such that if production next year looks like the production this year, that production is going to gin you up compensation payments of $800,000 instead of the $1 million that you got this year. And that can be a little bit painful. The doctors, there may be a lot of them, and none of them are getting retire and live at the beach kind of money. So the reduction in compensation is material. There can be some ways to improve that with payer contracting and other efficiencies, but any significant improvement is going to be just kind of on their own back. But increasingly, the models have gotten more elaborate and driving towards creating opportunities to increase that compensation going forward on a basis other than their own production. And that usually goes by different names of income repair or other names. But the gist of it is that rather than having a compensation model that is purely personal production, you shift that to having a production model that is their compensation is based on aggregate profitability of either the practice that they are selling or the group of them that are being sold or everything within a state or some other subset of the business, with the idea being that if I was making $1 million and it went down to 800,000, rather than just increasing it by working harder, maybe we can kind of grow this business, hire mid-levels, expand through acquisition, and increase that pool in a way that could increase my compensation on the basis of profitability instead of just my own production. And the reason I kind of take a detour into those structures is A, to show that those are pretty elaborate, but B, to flag for you as a bidder that the topic of compensation, especially if it's in a banked deal, the topic of go-forward compensation is going to be pretty front and center with the selling doctors. And again, you have some choices to make of do you dive into that topic entirely? Do you leave that for a later discussion? Maybe that's a good idea. Maybe that's a bad idea in a particular context. But if you're going to be silent, the one thing to keep an eye on is that, especially in a banked deal, there's going to be people that are whispering, there's going to be other bidders that are whispering some of these models in your seller's ears, and those models often resonate with sellers. So the learning point here is that you need to be very thoughtful about if and what sort of compensation model you're going to be presenting, because it's a very, very significant topic to the sellers. And then also that these models are pretty elaborate. They're evolving, and the state of the art is moving at a constant rate, and the dynamics within them as it relates to production and ancillary services are all pretty loaded topics. And if you've not kind of delved into the particularities of those, we'd ask you to give us a call. We'd be happy to walk through some of that in greater detail, because it is a topic that if you're not fully familiar with, you probably need to become more familiar with as you're going out in the market and making proposals, in particular to groups of providers.
And we found clients have a lot of success in presenting the more sophisticated models in ways that they're presenting them to potential sellers in the context of how it leaves both an opportunity for income recapture with those sellers, but also the opportunity for autonomy and continued control over the split of funds amongst themselves and their partners. And that can be a real selling point when they're considering between different types of buyers, where some are going to exercise more day-to-day control over these former, self-employed owners. It can be a real selling point if you pitch to them the autonomy that you're leaving with them and the control that they're going to have over the growth of their income, and instead presenting it in a way where you're like, this is how I'm going to help you get more physicians in the door. And once we get those folks employed, this is how that's going to grow your income and benefit me as well. That viewpoint in that presentation in these conversations, we see people be really successful when they focus on the benefit to the physicians and not just the details of the model itself.
Exactly. Liza, we can probably flip to the next slide. Another topic that comes up often forcefully at the LOI stage, and so you should give some thought to it, is the concept of the restrictive covenants. In a typical M&A deal, you have two restrictive covenants. One is connected to the sale, one is connected to employment. And pretty traditionally, the sale one is going to be 4 or 5, maybe a little bit more, maybe a little bit less, but usually 4 or 5 years, and cover a pretty wide geographic scope. The idea being that that is the most enforceable covenant, that courts don't like the employment-related covenants. So when you're selling your business, you shouldn't be able to, the seller shouldn't be able to steal it back from you. So the courts are more likely to respect those, both in terms of duration and the geographic scope. So you have the sale covenant, and then you've got the employment-related covenant, which is usually 1 to 2 years and much more narrowly geographically tailored to connect more to where the individual was working and the spheres of influence that they've had. And this is a hot topic in deals in particular, because you've got take a group of physicians, and the way that they're often thinking about it is that as opposed to a single owner of a large business where, again, you've got kind of retire and go to the beach sort of money, a lot of these deals, the economics for a selling provider may be limited to still a lot of money, but a more modest amount. So you're getting $2-3 million. That's obviously real money, but probably not retirement money. And so the physicians are often having a lot of angst around the topic of, and I think this is not a constructive thought, because it's not how it actually works. They're worried that I'm going to sell the business, and then the MBAs are going to kind of come in and fire me, and I'm not going to be able to work. And if I want to work, I'm going to have to move my family. and that's all terrible. The buyer, on the other hand, is doing a bit of a different calculus of they're not really motivated to be terminating providers. That's the core of the business that they just bought. So that idea is not super compelling to them. But what they are worried about is that they are going to pay a ton of money for the go-forward goodwill of this business, which is largely the services of providers. Then they have a bunch of providers jump ship and do something else. While you can't force people to stay working, the non-compete is one of the levers that a buyer is often interested in to make it difficult for people to leave. It's an imperfect tool, but that's often how they're thinking about it.
And one thing to consider when negotiating these is this is a point where if it's not settled in the LOI stage, it will be negotiated for the entire duration of the deal and will probably be open right up until the very end when folks, will eventually come to a solution that they're both equally unhappy with. But physician practice non-competes, even in the purchase agreements, physicians often want those tied to their ongoing employment in more strongly even than we see in other industries. And we definitely recommend against that. We want to keep them separate. But if you are agreeing to forfeit your purchase agreement non-compete, it's important to independently evaluate what is the likely reason for this person exiting post-closing. We usually divide things into good leaver, bad leaver buckets. That doesn't work super well in a physician context because they can continue to work for you, but they can put you in a position where you're forced to fire them. Or also you may have cause termination rights for a physician, but you decide that you're going to terminate them without cause to avoid a court fight about it. And so these are just areas where you have to be very, very pragmatic about what's going to actually happen and not just kind of think about it hypothetically from 30,000 feet about what you need.
Right. The truth is that there's usually not mass exoduses. They'll have economics almost always connected to the go-forward enterprise. And so a little bit of balancing of hypothetical risks, and that cuts both ways of the doctors needing to be convinced that it's not a valid business proposition for a private equity fund to waltz in and fire everybody. It's just not how they work. And there's a number of tools as well that you can employ in those discussions. As you can kind of call the physician's bluff and say, okay, I know you're worried that we're going to fire you right away, but we're asking for a longer term non-compete. We'll commit to keeping you employed. And you can kind of call the bluff on some of those things, but it can be a pretty loaded and emotional topic. And at the LOI stage, you should give some thought to, do you want to pin this down? Do you want to skip this as an emotional topic for a later date? Skipping it can be enticing, but as Alyssa mentions, it's often an issue that sticks around into the end. And in our experience, the leverage starts, you'd think that as you get closer to a deal, that the leverage would start to run to the buyer. That's not always how it works. The buyer becomes increasingly more committed to the deal, and financially they're incurring a lot of expenses, and the leverage sometimes runs directly to the selling doctors, and you end up negotiating that point in a context where they hold a lot of leverage in those discussions, which can make it pretty painful. Another topic that comes up, and we would encourage you to think about this one right at the outset, maybe even before an LOI, but a very difficult element is that these providers in a practice, they typically are buying into ownership for a relatively small dollar amount, like $30,000, $40,000, $50,000. And then that entitles them to a percentage of the profits of the practice on a year-by-year basis. And then when they retire, they get their $30,000, $40,000 back or $40,000 back. So it's kind of in small, you get some more along the way, and then out small. And all of a sudden, with this deal on the table, that buy-in and out for $40,000 is now a $3.5 million event if you're a partner, which puts a ton of strain on the doctors that were just a year or two away from being a partner. And those are you can imagine the anxiety that those doctors feel of missing that event. So, because it stinks to be late, as the slide says. The remedies around that topic are difficult in a provider context, because in a regular company, you'd probably use something in the vicinity of a profits interest that you would just hand to them and give them kind of like option upside. That is a challenging answer in a regulated environment, or you just give them the equity, or you shift it around to get it the way you want it. That can be a tax poor outcome. The general gist of it is that the best thing they can do is for the seller to give some thought to this topic and make any adjustments that they need to make before you're handing them an LOI and you're pegging now a huge value to this equity. The best answer is for them to do a little bit of house cleaning in advance and avoid some of these issues, or at least create tax reportable positions that are getting them where they want to go. Short of that, you end up with an issue where you've got some real winners and losers, and that can be a challenge on the business going forward.
And we find that we'll hear from clients that they'll say things like, well, I brought this up to the seller at the management presentation stage, and seller didn't do anything about it. And we would just really encourage you to, one thing that we say is like, whether you go with McGuire Woods or with a different firm, we're happy to help you out at LOI stage. I would almost recommend that you revise that for your presentation to these potential sellers, which is whether you go with my deal or with another deal, start thinking about whether you need to elevate anyone. Because if they do come with your deal, everyone is going to be a lot happier if those folks were elevated at the right time.
And from a tax perspective, that's a window, the ability to fix that is a window that closes rather quickly. And doing it sooner might be available in ways that doing it later is just not. Liza, we can probably flip to the next slide. Another issue that we see very, very regularly when we were not involved in drafting an LOI is that it'll hit our desk with some form of contingency or earnout baked into it. And we totally understand the dynamics of why buyers want that contingency. It might be a bridge to pricing, that you're willing to offer a certain amount if what they are saying as far as performance post-closing is true. It's a perfect bridge for a lot of business issues. However, the takeaway on this topic for healthcare investors is that you want to give some careful thought to interjecting any form of contingency, whether that's an earnout or a contingent note, or any other form where the purchase price is not secure at the moment of the closing. And the reason is that there are some pretty involved regulatory limitations on whether and in what circumstances that's going to even be viable. And the challenge you will have is if you've committed to that sort of, if you committed to a price and a portion of that price is contingent, if we roll in on the legal side after the fact and say, well, that contingency is not doable or not doable in that way, and the way that it is doable is not solving your business problem, you as a buyer are going to have a difficult time changing the price and not just losing the contingency in your bid. So our advice would be to talk about those topics early. And they can have, and not to delve too far into the regulatory nuances, but they can have both Stark and anti-kickback implications that, and if you've dealt much with healthcare deals, you'll know that Stark and anti-kickback implications are big dollar implications. and can be the third rail that you're not going to be able to go over and touch. And so give some careful thought to how you're going to go about doing those sorts of contingencies, if you're even going to be able to do them at all. There is sometimes, in certain contexts, an ability to have elements of contingency, but you need to be careful about that. If you can navigate the black-white part of it, where it's either in or out as to legality, then you end up in a kind of a spectrum analysis where different factors come into play. How long is the contingency? Is it aspirational, asking them to do more than just kind of show up and continue doing what they were doing before? How big is it? All of those things kind of touch on whether or not it's going to be feasible, and if feasible, on what terms.
And also another layer to consider is that as you move some of these contingent consideration posts, it can also change the tax dynamic of whether this can be considered purchase price or if it's going to shift over into the ordinary income bucket. And you might find that if you're taking a riskier regulatory position and then combining that with a riskier tax position, it may be the case that it makes more sense from a business perspective to characterize this as an income bonus from the start. And you have a lot more latitude when talking employment compensation with physicians, and then you also will, you don't have to worry about whether the tax bill is going to come due at a level that they didn't think it was going to come due at anyway.
Very helpful. Liza, maybe flip to the next slide. We'll keep rolling through some of these topics. Another issue that kind of comes in often through the back door is retention. We talked a little bit about it before, but if you're buying a provider business, you can't have significant portions of the doctors all leave. And a non-compete is not a foolproof mechanism for that. Even if you had a full 5-year non-compete, if it's a Chicago provider business and you put a non-compete, you're not going to be able to non-compete your way to keeping a provider from leaving and opening up a new practice in Dallas or somewhere that your non-compete can't conceivably connect to. So there are some solutions, and we've touched a little bit on it before, so we'll zip through them, is that you can call the bluff on the concern and create some mutuality of the contract, what we often refer to as a baseball style contract, where there's no termination early by the employer and pay severance. If you're making a 5-year commitment, you're making a 5-year commitment, absent cause, which is very, very difficult to have that be something that happens. So you can make it mutuality of that commitment. That's one way to force a longer-term commitment from the providers. You can put contingency around the rollover. So if they're getting a cash portion and an equity portion, it's more acceptable from both a regulatory and a tax perspective for the rollover to be forfeitable. So high vesting, maybe cliff vesting all the way out to 5 years or a portion of it each year. That gives a hook on them. Or we see some more aggressive levers that folks will sometimes want to do, more punishing economic sanctions for leaving early, where the buyer is really trying to claw back not just the rollover, but claw back some of that doctor's purchase price. That's where, as Alyssa mentioned, you add those kind of hooks on it, you start to wander into tax gray areas where, is this even a purchase price if it's connected to a doctor's employment? Maybe it's compensatory, which is a bad outcome. The retention issue is a difficult one to solve. And frankly, a lot of the buyer solutions are pretty clumsy as an effective tool. And there's a certain amount of that kind of risk that you're ultimately going to have to just bear. And so having the best retention model is not sticks to beat them back from leaving, but a little bit more candy, not necessarily compensation, but a better work environment, better relationships with the doctors. Not telling you all things that you don't know, but the tools to force retention are pretty difficult to come by. Another topic that can be very, very difficult is when the target is formulated as a C corp. When you have a C corp, the seller is going to be very intolerant of an asset sale where they're paying 2 layers of tax. Then that's going to force you to do some form of equity deal. And we talked a little bit about corporate practice limits may mean that you as the buyer can't buy the equity of that practice, but there's some elaborate structures where we can kind of separate that C corp into 2 C corps, where one is the practice and one is a C corp management company, and you could buy that C corp management company and solve the seller's tax problems. But you'll now have you get no basis step up, and B, you're now going to have a C corp in your structure, which is not fatal, but does add some complexity. But there may be no way really around that. If you have to buy either assets or stock, you're going to have to buy stock. Sometimes you can make the sellers may want to make a stickier tax argument and say that there is an asset they can sell, and that's their own personal goodwill. That's an edgier tax position. Sometimes we'll tolerate it if it's in a setting where we're just walking away from the practice entirely and just bringing the goodwill into our business. But it's an edgier tax position, and it may not be available especially on a larger practice where the doctors have already signed non-competes, because when you sign a non-compete, you're basically, and from a tax perspective, you are delivering your personal goodwill to that corporation. So the C corp can really be a vexing problem. So if you're at an LOI stage and you see a business that is in corporate form, it's often worthwhile to get some level of confirmation that they're at least an S corp. An S corp has its own complications, but it's easier to work around than a C corp. Liza, we can flip to our next slide, which I think is our last one. And we'll just touch on this briefly. When we're talking about the compensation structures going forward, we talk about the income repair and these models where profitability is being shared. Another area where the complexity in recent years has gotten very, very involved is mechanisms around sharing of ancillary services revenue. In a provider business, one of the main models of growth for a private equity fund in looking at a provider service business is that in addition to kind of the regular private equity levers of kind of utilizing debt, which can enhance your return, you'll have some scale that might either have some efficiencies or enable better contracting. One of the drivers in these businesses is the fact that when you do have scale, you will likely be able to internalize more of the ancillary services revenue than what a smaller practice would have been able to do. You might be able to buy imaging equipment or bring in those revenues in ways that a smaller one can't. And where this shows up in the negotiation is that's now a future value that is kind of on the table for negotiation, and sophisticated sellers in particular are really zeroing in on that even at the LOI stage. They want to delve through ideas around how they want to share some of that ancillary services revenue. And the takeaway for that here is that's difficult to do on the front end before you've kind of done all the diligence in connection with what that revenue looks like, number one. And number two, kind of from our perspective on the legal end, sharing of ancillary services revenue is a very technical and high stakes affair. And we would absolutely encourage you at the LOI stage to kind of shy away of delving too far into that topic, just because it's going to be very difficult, it's going to be very involved, and it's going to depend on some analysis of what they're doing and what you're wanting to do, and having the information, time, and interest to doing that kind of deep dive at the LOI stage is something that we'd probably advise you to shy away from. So that topic does come up, and sometimes we'll see that in an LOI where some stuff has been pre-agreed, but our recommendation on that is to shy away from delving too far into how the go-forward business is going to be dealing with any sharing of ancillary services revenue.
And another topic to just that has kind of flowed through each of these different slides that we walked through is to also remember that while you in preparing an LOI may be able to get comfortable with a certain level of risk, the more creative you are in agreeing to things in the LOI may limit your ability to find both lenders and equity funding sources that may be able to get comfortable with that same construct. Particularly, lenders can be very conservative. And so if you're walking into a construct in an LOI that is on the riskier end of the spectrum, you may be limiting yourself in your ability to ultimately fund the deal. And so that's something to consider as well. Not just will you be able to get comfortable with it, but let's talk about how frequent it is in the market to see if we're going to be able to get our funding sources comfortable with it as well. Some folks are just very conservative by nature. Even if the risk is small, their tolerance may be zero.
And part of that is because in healthcare in particular, there might be a range of probability as to whether or not it's going to be a problem with the regulator, but that range of probability often kind of connects with binary outcome order of magnitude risk. So how high of a percentage are you willing to go down when it's a live or die type of risk? It kind of supercharges a lot of these discussions. And our last kind of recommendation, and we say this to folks all the time, is we would encourage you in these to absolutely use us as a resource. We're pretty, I think, generous with our time at this stage, and we'd much rather take a look at an LOI and let you know if you're heading into a buzzsaw and make some adjustments there than kind of fielding it after the fact. And especially at an LOI stage, the level of effort that takes from us is pretty limited, and if it doesn't go anywhere, we'll write that off. We're always happy to do that, but we would encourage you to use us as a resource. And in healthcare deals in particular, sometimes in general, independent sponsors and private equity folks often have multiple legal relationships. When it comes to healthcare, we would recommend really connecting both the kind of the M&A private equity skill set with regulatory expertise, because the regulatory issues are just woven through all of these things, as you can see from this discussion. And we're able to kind of navigate those at the same time. So a little plug for us here at the end. But wrapping this up for everyone, hope this has been helpful. We're going to do these on a pretty regular basis. We're hoping to see you at our independent sponsor conference, and stay tuned for other kind of programming around that conference that's going to be for this community. And as always, if you're looking at a deal and want us to take a look at it, give us a call. We'll see you all soon.